the biggest factors affecting gold right now: inflation and geopolitical tensions in Eastern Europe. How will these forces drive the gold market going forward? We're here to discuss with Gary Wagner, editor of thegoldforecast.com. Gary, welcome back to the show. You came at a very opportune time this week. I'm glad to be speaking with you today. A lot of exciting news to cover. Let's start with inflation. Gary, as you know, highest in 40 years. This headline CPI is now at 7.5%. As we're speaking today on Tuesday, the PPI came out today. Core PPI is now at 6.9%. You were telling me offline, this is significant because it means that wholesale prices haven't gone down. In fact, they're up year to year on a year-to-year basis. And wholesale prices, elevated wholesale prices, you told me, are an indication of sustained inflation to come. Can you elaborate on this?
Well, first of all, great to be here. And absolutely, that's a great point that you bring up. The PPI, Producer Price Index, that came out today, came out with an uptick in it. Now, obviously, as wholesale prices go up for manufacturers, for goods and services, they will inevitably pass those higher prices on to the consumer. So anytime you have the PPI going higher, the first thing that it tells you is that inflationary pressures aren't stabilizing, they're not peaking. They are, in fact, going to continue to move higher. Add that to the PCE that came out. That is now also at a 40-year high. And really what we're looking at is persistent inflation that I believe will not go to a target level, acceptable target level by the Federal Reserve for at least a year to 2 years.
So you're saying that inflation is going to stay elevated at around 7% for 2 more years, Gary? Is that what I'm getting from you?
No, my point is that it will continue to rise for a bit. We haven't seen any data suggesting it's come to a peak. But once it comes to a peak, we're not going to take inflationary pressures at 7% and move them to acceptable targets from the Fed of 2 or 3% immediately. That will be a multi-year process. So once we see inflationary pressures peak, it might take 3 or 4 months to bring it from 7 down to 6 or 5.5. The process is going to take some time. It will take a number of years to bring it back down to their target level of 2 or 3 if they tick it up a little bit. So I'm not saying it's going to stay at 7% for a year and a half, but I'm going to say that it's going to take a year and a half to bring it down to acceptable levels.
Now, Gary, I want to get your take on the source of this inflation. I've heard different schools of thoughts from different economists. There's one camp that thinks that, they agree with Powell in the sense that inflation is transitory because it was caused by supply chain bottleneck issues and logistical problems that are happening all around the world. Of course, Omicron has expedited these logistical issues. So eventually, as these problems fix themselves, inflation will come back down to more normalized levels. The other school of thought from the monetarists, they think that, to quote Milton Friedman, inflation is everywhere and always a monetary phenomenon, meaning that the increase in the money supply, the M2 at record levels, that was the source of inflation. Where do you stand?
I believe that there is truth in both of those statements. Both the enhanced or increased monetary supply, the level of our national debt, the asset sheet of the Federal Reserve is a component, and the thought that inflation is transitory because of supply chain bottlenecks, I believe is incorrect in that it's transitory. I believe it will be much more persistent than the Fed is making out that it is. And I think it's a combination of both. Now, what is the solution is the real question to getting inflation down. The first thing is that no matter how aggressive the Federal Reserve is by raising rates, the only thing that it accomplishes is it forces consumers to buy less. And I think that a lot of the inflationary pressures is the direct result of pent-up demand over the recession. And what we're seeing is that they know, meaning the Fed, that if they raise interest rates too quickly, it will contract the economic expansion that's currently underway and wreak havoc on the U.S. economy. So they have to be very delicate, a balancing act, so to speak, in how they actually go ahead and raise rates. However, the real issue is the supply chain bottlenecks. And the Federal Reserve can reduce the amount that companies and consumers spend, but they can't solve the issue, as you mentioned, of the logistics of getting components from one place to the other and keeping up with the demand that's currently there. And it's for that reason that my last statement, meaning that inflation will go down as a multi-year process, I believe will hold true. The other thing is that really what has to happen to get to a 2% target of inflation, they have to resolve the supply chain problems that they're having, the bottlenecks.
Yeah.
Now, we saw oil come down today, and that came down because there seems to be a pause or not as much tension with the geopolitical concerns between Russia and the Ukraine. Putin said that he was taking troops away. The exercises are over. But from what I've heard in the most recent news reports, there is no data or confirmation that he's taking the primary troops that are amassing on the Ukraine border. He hasn't changed that. He's moved some from another area that were involved in a military exercise. So I agree that there are two kind of trains of thought in terms of why inflation is so high, but I believe it's a combination of both of them.
All right, Gary, we're going to circle back to Ukraine and Russia in just a bit. But first, I'm going to talk about how gold and perhaps other assets are going to react to inflation, this sustained level of inflation that you're talking to me about. I have here two charts, the first showing headline inflation versus gold. Now, this chart is significant in a number of ways. First, it shows that gold, first of all, has not kept pace with inflation over the last year. As you can see in the blue line, headline CPI is now at 7.5%. If you look at the left side of the y-axis. And on the right side, the orange line shows the GLD ETF. Again, it's only growing in the single digits, not yet at 10%. So compared to where it was last year, where it was growing on an annualized basis of over 30%, gold seems to be slowing down relative to the pace of inflation. So that's number one. I'd like to see where inflation is going to lead gold, or perhaps the other way around going forward. Now, the other chart I have for you is the same thing, except we're showing the S&P 500 now. So headline inflation versus stocks. Similar story here, actually. Now, stocks have been going up steadily, but on an annualized percentage change basis, stocks have not kept pace with inflation. As you can see, the orange line has been trending downwards, while the blue line, which signifies or which shows inflation, rather, that line has been steadily trending upwards nonstop since basically 2 years ago. So, are assets able to keep pace with inflation right now? Any asset, stocks, inflation, even cryptocurrencies, stocks, gold, I meant cryptocurrencies, none of these things seem to be keeping pace with inflation right now.
Well, I'll address both the U.S. equities markets as well as gold. I'll stay away from cryptos as I'm not an expert.
Sure.
But I think the wild card that we're seeing is the fact that it's acknowledged that the Federal Reserve is going to go to interest rate normalization. It's been kept between, in essence, at zero for so many years that even these small hikes of a quarter, maybe as much as a full percent, are slowly being factored into pricing in U.S. equities. Equities are up to date, but they have been under pressure for a couple of weeks. And I believe that the pressure they were under was a direct result of the future actions of the Federal Reserve. So they're pricing in a more aggressive Fed that will raise rates. I think it was Bullard from the St. Louis Bank that came out and said that he believes we should see a full percentage rate hike by July of this year, a very hawkish and aggressive stance, regardless of how quickly they raise it. Because remember, initially, we were supposed to get a series of 3 rate hikes of 0.25%, which would take the Fed's fund rate from 0 to 0.25 basis point or 0.25% up to 1%. And now the hawkish arm of the Federal Reserve is saying, no, we want to raise it by 1%, taking Fed funds rate to, in essence, 1.25% in the next few months. So as this is a dynamic change in the Federal Reserve, we are seeing that kind of a knee-jerk reaction to the acknowledgement that rates are no longer going to be at zero. There is not going to be free money, as there has been for these corporations that did exceedingly well during the recession through 2020, to a great degree, 2019, the second half. Equities were just ascending to unreal valuations, and that was based upon the fact that they could expand and borrow at zero cost. So that's why I think we see that kind of a loose correlation on the chart that you showed with stocks. Now, as far as gold goes, I think that gold is a hedge against inflation, but it greatly lags behind real-time data. And so while we've seen it pick up, I believe that if in fact the levels of inflation have not peaked and that it will be a multi-year process to bring it down, then what we will see is gold at some point start to play catch up to the current environment of high, record high, 40-year high levels of inflation. So we're not yet positioned with gold being in a full bullish demeanor, as I'll show on one of my charts in a second, but I think that it's very possible that we will get there.
Okay, so slightly bullish sentiment from you. What about the other kicker? Let's talk about geopolitical tensions. What if there's war in Eastern Europe? Well, it's not looking likely. Well, maybe it is likely. It's not looking certain. Let's put it that way. It's not looking certain that Russia is going to invade Ukraine right now. Actually, yesterday, the Ukrainian president, Volodymyr Zelensky, he came out and said that Russia is definitely going to invade on the 16th, which is this week. And then he backtracked on that and said that, oh, hang on, that's not what I meant. I was just quoting other media reports on what they speculated would be the possible invasion date. I don't actually mean Russia is going to invade tomorrow. And so he backtracked on that. Gold and oil spiked as soon as he said that, but then markets didn't seem to react. There's a headline here. Ukraine president walks back statement that Russia will attack Wednesday. So a lot is going on right now. Nobody knows for certain whether or not Putin's going to invade. It looks today, as we speak, new headlines are coming out basically every hour. It looks today like Putin is pulling troops, or some troops, back into Russian bases, so away from the border. So maybe things are de-escalating. Anyway, how do you see it?
Well, I mean, it's interesting. In terms of the statement made by the president of Ukraine, last week, the National Security Advisor for the United States came out and they said, first of all, if you're American and you're in Ukraine, you have to leave, because if this escalates, we're not going to do a rescue operation. But what he said that was critical was that it appears as though Russians have now amassed enough equipment and troops on the border to actually engage in a full-scale movement into the Ukraine. That's what he said. He didn't say that an invasion is imminent. He didn't say that they're about to cross the line. He said that they have made the preparation, so if they wanted to, they could. Later on, I heard statements in the news that said invasion is imminent. And that's not what the words that came out of either the National Security Advisor or out of Britain that also made a warning. So it was blown way out of proportion. And that's when we saw gold really spike, which was last week. We saw it rise up until today, when it became common knowledge that Putin is softening his tone. But he's never said he's going to invade. He always maintained that he's not. So let's assume that what he says is factual. We don't know. No one knows what he's thinking. But for a second, let's assume that he is factual. What benefits could he have by putting all of those troops on the border if he doesn't plan on invading? And the advantage he can gain is the last thing he wants is for Ukraine to become part of NATO. And so he needs, the carrot doesn't work, so he needs the stick. And the stick, I believe, is by showing that show of strength, he can really strong arm Ukraine and NATO in making the commitment that Ukraine will stay away from NATO. And that's what I think we're seeing there. The last part of your question was, what would happen if there was an invasion? The problem with an invasion is that it could morph into a multi-country skirmish. And that would be a catastrophe all around. And if that does happen, which I don't think it will, but again, I don't know, that would send gold flying. That would have the stock market crashing. It would have such terrible repercussions that, at least to me, it's unthinkable that that would be where this leads to.
Natural gas and oil are a big part of Russia's exports. So to your point about what Putin can gain from all this, well, all he has to do is scare the oil markets into going up, which technically he has. Maybe that's all he was after. Who knows? But I'm no geopolitical expert. I'm not here to speculate. I'm just saying that maybe his motives are easier to deduce than we're making them out to be. But suppose you're right. Suppose nothing happens. Well, actually, let's suppose the other way around. Suppose something does happen. Suppose an invasion does happen. What's going to happen to gold? Geopolitical tensions in the past, if you look at the escalations of wars or the beginnings of major conflicts, mainly it's oil that has spiked up and stayed dramatically higher. Gold, if you look at the start of the Gulf War, Operation Iraqi Freedom, the invasion of Afghanistan, none of those things have really spiked gold up and kept gold up. That's my point. It hasn't really, geopolitical tensions and conflicts in the past have not really sustained a gold bull rally. Can this time be any different?
I believe it could, if that's the scenario we want to speculate on. The other, one thing first, that's an excellent point about natural gas and oil. The other thing that really caused Russia to benefit is the price of palladium. Because palladium has spiked, I think the other day it was up $167 an ounce. I remember when I first started in the industry, palladium prices were around $100 an ounce, just above silver. And now they're the most expensive precious metal traded on the futures market, with Russia producing 40% of the global production. So it could benefit him there. The difference between if an invasion happens into the Ukraine by Russia, as opposed to the other skirmishes that you had just mentioned, it was unlikely in regards to Afghanistan or Iraq, it was unlikely that it would drag multiple countries in with massive amounts of troops. It doesn't seem to be the same scenario, because the implications of a full-scale invasion into Ukraine and NATO really beefing up all of the countries that surround the Ukraine, and think about all of the defensive military goods that have been sent to Ukraine by the United States and a lot from the European Union. It has the potential to really enlarge and involve many countries, and possibly causing a major war. I'm not going to say world war, but a major conflict that the attack on Iraq, or the attack in Afghanistan would not do.
Are you saying that an attack on Ukraine by Russia is going to drag NATO into the conflict?
Well, it already has. Realize that
I'm talking about direct military intervention by the U.S. and its allies.
Not direct. Well, I don't see that, because they're not going to defend a non-NATO country. However, they have been sending massive amounts of military defensive equipment, both NATO countries and the United States, to the Ukraine. So they have been involved, not directly, not with troops on the ground in that country, but we've had additional troops in the United States, I believe about 8,500, moved to NATO-based countries. They're in Poland, they're in different countries where the proximity to Ukraine is very close. So It doesn't have to be direct involvement. It could be involvement that's just arming them with weaponry, because that's not going to please Russia.
Right.
And that could escalate.
All right. Well, we're speculating as to what Putin is going to do. Nobody knows except Putin. Let's talk about what we do know, which is what the gold market's going to do in response to any such scenario. So let's sum this up. Are you more bearish or bullish in the near to medium term, given your outlook on inflation and given the tensions in Eastern Europe?
Absolutely more bullish, and it's not a mild level of bullishness. I think that if inflation is not put in check, because that's really the primary issue, geopolitical tensions tend to be a blip in terms of a long period of time, and they resolve themselves because of the fact that all countries have an immense amount of armament. You don't want to get into that kind of a brutal conflict. But inflation is acting on its own. And my belief and my fear is that even by raising interest rates, even if they raise them 2% this year, which I don't believe that they will, we could see something like a full percentage, 1.5% this year. I don't believe that that level of interest rates is going to have a huge effect on the level of inflationary pressures, which is why I believe that they are much more persistent than they are transitory. And even if they are transitory, I put the timeline for transitory over years and not months. I don't see them any action that just involves raising rates, taking the 7% CPI down to 4% by raising rates by 2%.
Just on your point about war, if war does break out, if we do have a massive conflict that involves several nations' militaries, wouldn't the dollar benefit the most? The dollar is seen as a safe haven still, and if that were to occur, wouldn't that put downward pressure on gold?
On the surface, it's going to pressure gold, but not necessarily take it lower. Look at recent activity in the dollar. As the tensions built between Russia and the Ukraine, we had multiple days over the last couple of weeks in which we saw safe haven plays into the dollar and gold concurrently. So while it would pressure gold, it does not mean it would be holding back the amount of the rise, but not necessarily being so strong that gold moved down with that adversity. So I don't think that you would see that. I think the dollar strength and gold can move in tandem during that kind of a conflict, in the same way that U.S. equities and gold move in tandem when you have a highly accommodative Federal Reserve. We've seen that on many occasions where the stock market is running and gold is running concurrently, when typically there's an inverse relationship there, one being a risk asset and the other one being a safe haven asset. So it would have an effect on gold, but I don't think it would stifle gold moving higher. It would lessen the amount the gold move higher.
Let's take a look at some of your charts now and talk about, close off on your technical analysis. You were telling me about a golden cross that gold has just breached. Tell us about that.
Right. Well, let me give this a setup. What we're looking at is a long-term chart that goes back into 2019, and it really shows the rise up to the peak at 2088. As that occurred, what you can see, I've got three moving averages. The one on top is a dashed green line that represents the 50-day, a blue dashed line which represents the 200-day, and then the red line represents, the blue line is a 100 and the red line is a 200. And you can see you've got the 50, 100, and 200. That is what we call full bullish alignment. And then as the market came down, you see where the 50 goes in and it crosses below the 100, then the 200. And you've had kind of almost a movement where they continually cross, which is why, I'll blow this up now, you can see right now in recent history over the last, say, week, we have had a golden cross, but if you look back, 2.5, 3 weeks ago, we had a death cross with the 50-day moving below the 200-day. My point of this is that what we need to inevitably see to believe that we're going to have a substantial move in gold long term, and I believe that would be based on them not being able to curtail the current level of inflation quickly, is you need to see it back in bullish alignment. If this stays the way it is, we still need to see this dashed blue line on the bottom move above the 200, and that would be full bullish alignment, and that would curtail a major move in gold, and I think near the highs of what we saw in August of 2020 when gold hit 2088.
Whoa, okay, hold up. So that's your target, 2088?
Well, I've just put up one of the models that I use, and this is a combination of Elliott wave, excuse me, and Fibonacci extension. What you can see is this is the high, it's labeled as a 3, and then we had the long correction that lasted until the first part of 2021, taking gold down to 1678. It then rose to 1920. And what we've seen recently, really throughout the second half of last year and into this year, is a narrowing of range in gold. In other words, we've had this series of lower highs and higher lows. And recently, you can really see it in the daily, but recently we broke above that price point. And so what I believe is that if we have this inflation level remain more persistent than believed, I think that we could see gold short term over the next, say, 3 to 6 months go as high as 2015.
Okay.
So certainly
perfect.
not beating the record, but I believe that we could see substantially higher prices. And I'm leaving out if the geopolitical tensions actually evolve into something major. This is based on levels of inflation at 7%, a 40-year high, and what the Federal Reserve is going to do. Because, of course, when you raise interest rates, it's a push-pull scenario with gold. Gold reacts favorably to inflation and the opposite to higher interest rates. I think we have that opportunity.
I'm guessing you're implying that should war actually take place, gold will go even higher than your $2,000 forecast, right?
That is correct. My long-term forecast, based on the scenario that inflation remains persistent at high levels over the next 2 years, and I don't mean at 7%. I mean a year later, it's only at 5 or 4.5, and 2 years later, it's still at 4%, meaning the cost of goods and services continue to outweigh real wages in America, because that's what's happening. I think that we would see a series of peaks and valleys with my upper level at 2,100, which is just above the record high.
Excellent. Gary, I want to thank you so much for your deep dive today. Excellent insights, very thorough analysis. We went through a lot. Thank you for your time.
Thank you very much for having me.
And thank you for watching Kitco News. I'm David Lynn. Stay tuned for more, and don't forget to subscribe to our YouTube channel.